Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NOVANTA INC quarterly report. Novanta Inc. offers a diverse range of businesses and services across two segments: automation, enabling technologies, and medical solutions. The company's products include precision medicine solutions, laser beam delivery components and solutions, see OTWO lasers, and solid-state lasers, ultrafast lasers, optical and inductive encoders, precision motors and integrated stepper motors, servo drives and motion control solutions, intelligent robotic end-of-arm technology solutions, air bearing spindles in the medical solutions segment. Novanta provides medical-grade technologies such as medical insufflators, pumps, and related disposables, laser beam delivery solutions, video processing, streaming, and capture machine vision technologies, radio frequency identification, RFID, technologies, barcode identification technologies, thermal chart recorders, light and color measurement technologies, touch panel displays, advanced motion control solutions. The company sells its products through a direct sales force and distributors under various brands. The decline of Novanta Inc.'s NOVT stock price over the past year can be attributed to several key events that have contributed to investor concerns. The company's Cone 2025 earnings report, which narrowly missed revenue projections despite beating EPS forecasts, led to a 3.98% drop in stock price. This was followed by flat organic growth and a decline in GAAP profit in the second quarter, prompting institutional investors to reduce their stake. The mixed third quarter report, where Q4 guidance fell short of expectations, further weighed on the stock price. These operational headwinds and disappointing financial results have collectively led to a 21.46% drop in Novanta's stock price over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the introduction of new products, increased demand for robotics and automation products, and factory productivity improvements. Additionally, a favorable product mix has contributed to revenue growth in certain segments. On the other hand, revenue decline is mainly attributed to decreased demand for precision manufacturing products, restructuring costs, and increased R&D expenses. These factors have negatively impacted revenue growth in specific segments. In terms of segment performance, automation enabling technologies has seen significant growth due to its increase in gross profit and decrease in restructuring and acquisition costs. In contrast, medical solutions has experienced a decline in operating income due to increased restructuring and acquisition costs. Net income and profit margins experienced significant declines between 2024 and 2025. Net income decreased by $8.5 million, 44%, from 2024 to 2025, with a further decline of $11.3 million, 23.1%, for the year ended September 26, 2025. The medical solutions segment saw an even steeper drop of $13.9 million, 27.5%. Profit margins also suffered, with the operating profit margin decreasing from 13% to 9% in 2025. This decline was attributed to a decrease in net income, as well as increases in depreciation and amortization and provision for inventory excess and obsolescence. Segment-wise analysis revealed similar trends, with the automation enabling technology segment experiencing a slight increase in profit margins for the 9 months ended September 26, 2025, but still showing a decline from 2024. The medical solutions segment saw a significant decrease in profit margins. The reasons behind these changes were largely external, including weaknesses in end markets, economic and political uncertainty, reduced demand for products, inflationary conditions, price increases not being accepted by customers, and increases in costs not adequately offset by price increases. The company is indeed generating positive operating cash flow. Despite a decrease in net cash provided by operating activities due to increased inventory and higher taxes paid, the overall trend remains positive, with $55,251 generated during the 9 months ended September 26, 2025. This indicates that the company's operations are producing sufficient cash to cover its expenses and investments, positioning it for continued financial stability. The company's debt level has experienced a significant increase from 2024 to 2025, with total debt rising by 9.6% to $451,343,000. This is reflected in both the current portion of long-term debt and long-term debt itself, which have increased by $994,000 and $33 $709,000 respectively. In contrast, interest expenses have decreased over the same period. Cash paid for interest has dropped from $25,376 to $17,879, while net interest expense has also declined by $1.9 million in Q3 2025 and $7.1 million in YTD 2025 compared to the prior year periods. The financial performance of our company's segments has shown mixed results over the past year. In the short term, automation-enabling technologies struggled, but demonstrated a turnaround in the long term. Conversely, medical solutions excelled in both timeframes, showcasing its stability and growth potential. The company's financial summary reveals two key points regarding its capital distribution strategy. Firstly, the company has chosen not to pay dividends to its shareholders. Secondly, there is no evidence to suggest that it has engaged in share buybacks. These decisions indicate a focus on retaining earnings and investing in growth opportunities rather than distributing profits to investors. Concerns about inventory buildup and supply chain disruption. The company's financial summary reveals concerns about inventory buildup, which could have significant implications for its operations. The provision for inventory excess and obsolescence has increased significantly from $7,325 to $2,677, indicating a growing issue with inventory management. Furthermore, inventories have decreased substantially from $416 million to a negative balance of $27,312 million, suggesting that the company may be struggling to manage its stock levels. The impact of inventory buildup is also evident in the company's gross profit and gross profit margin, which are influenced by this factor, page 39. Additionally, an increase in inventory has been noted, page 45, further highlighting the issue. These concerns suggest that the company may face supply chain disruptions or difficulties in managing its inventory levels, potentially affecting its overall performance. That concludes the financial summary for NOVANTA INC. Feel free to comment below, and I will be happy to answer them when possible.